In New York, and for Emily Chang, this is Bloomberg Technology. Coming up in the next hour, Morgan Stanley slashed its worst case scenario for Tesla's share price to just $10 on concerns around Chinese demand and electric car market saturation. Plus, the U.S. granted a 90-day reprieve for some American companies relying on Huawei equipment, giving them time to adjust to last week's ban. But China vows to retaliate for the blacklisting of Huawei and accuse the U.S. of undermining more than a year of talks. And they are one of the most powerful and wealthiest families in South Korea. We discuss the current intrigue behind Samsung chairman Lee Kun-hee and his heirs. But first, to our top story. Analysts at Morgan Stanley are pumping the brakes on Tesla. The firm slashed their worst case scenario for the share price to just $10 from $97. The analyst is saying that demand is at the heart of the problem, but did maintain a price target of $230. Shares were lower through most of today's session, but we just closed about unchanged for the day. Joining us to discuss Tesla's bump on the road is Colin Rush of Oppenheimer. Also with us, Max Chafkin of Bloomberg Business Week. So Max, let me just start with you, sort of set the stage for us. It's been a few hours since we got that news. What bear case scenario is that? Is that realistic to be a $10 stock? Well, again, worst case scenario. So, I don't know. The worst case scenario probably, and Elon Musk has brought this up, is that Tesla could die for, some terrible reason, either because it, fails to deliver their cars or because, the terrible short sellers kill it or whatever. He's laid out all these threats. I think what's happening right now is, Tesla is a stock that is very polarizing. It's a company that's very polarizing. There's this amazing upside scenario where it takes over the entire automotive industry. It eats personal transportation as we know it, and then there's also this downside scenario because really they have two successful cars and a lot of big plans, and we don't yet know where those plans are going to wind up. Well, Colin, what I love about having you on today is I believe you have an outperform. So walk me through your downside risks here and your bear case scenario. Do you see anything of the downside risks that the analysts at Morgan Stanley are seeing?
So first, I haven't seen that note, and it seems a little hyperbolic or dramatic for him to make that call, especially given the history with the stock. But that said, I think what's really at stake right now is simple metrics. One, how many cars are they making and selling, and what margin are they getting on each of those cars? What we can see over the next couple of quarters is a company that's selling well into both the U.S. and Europe. China, we're going to see how things go, especially with this tariff discussion. But we are seeing ASPs hold up, and that's the average selling price, at a reasonable level, which allows them to generate a reasonable cash margin on these cars. I think there's an awful lot of noise around this organization given the vulnerability on the chart, and folks are looking at arguments that they wouldn't have made previously just because the chart's not looking very attractive right now. Well, Colin, when you talk about cash generation, we have to address the issue, which is the path to profitability. That was something that Elon Musk, I believe at the end of last year, had said that he really wanted to achieve this year and really every quarter going forward. Do you see that at risk now later on this year? We're not super concerned about that at this point. There's a couple of things that we're really looking at. One, we think that they're well below $35,000 on a cash cost for the Model 3. We think the average selling price for those vehicles is going to be above $50,000, and so there is a healthy margin there. And at volume, you're really, easily getting over the hurdle of the OPEX that they're spending on a quarterly basis. Now, as we put this forward a couple of years, what we're looking at is the need to continue to drive cost out, and I think they're taking the steps that they need to take right now to walk down that path over the next 2 years to hit the cost metrics down in the mid-20s, mid-20,000s for that Model 3 to remain profitable over the long term. Max, you've talked about having two successful cars, but do you see enough demand there? I mean, especially with what's going on in China. They have to be successful in China to meet those targets. Yeah, absolutely. And it's not just China. I mean, Tesla has taken it almost on faith that this car will have a lot of demand. And some of that is earned because as Colin kind of indicates when he's talking about margin, but reviewers have made similar points, this is a very successful car, kind of almost any way you slice it. But Tesla doesn't have the margin
marketing experience that other big car companies have, and we're talking about a new kind of product. And so there's been this kind of assumption that Tesla is basically the iPhone and it's going to change everything. And and if it does, like, it'll be a huge business that'll be worth much more than it's worth today. But if it doesn't, that's a pretty big ask, and it might not pan out.
Colin, I want to ask you about another analyst who came out with a note earlier this week. I think it was Dan Ives over at Wedbush, who said one of the biggest risks is they have to go to market and raise about $1 to $2 billion at the end of this year, which sort of just dilutes really everyone else involved and puts pressure on the valuation. And then they're concerned really about the ability to raise cash. Are you concerned that if Tesla has to tap the debt or equity markets, that they may not be able to?
So at this point, you've got $40 billion worth of market cap on the organization, and that's an awful lot of market cap to go out and raise capital. Now, that said, we're not convinced that they need to go out and raise additional money. Looking at what we're looking at in terms of volumes of vehicles and pretty healthy gross margin, they should be generating a fair amount of cash in the second half. And I think the company alluded to that, in any number of calls and documents, that's where they're headed. And I think this recent cash raise was really largely driven by some of the working capital needs, as well as some of the investments that they want to make in the autonomous program.
So, Colin, with an outperform right now, we just closed at about a 205 on the stock. We've talked a lot about the downside risks. What's the upside potential?
The simple upside is that they continue to make cars and people continue to buy them and at a healthy rate, and that's what we're continuing to see right now. And then the second layer of this is really, can they migrate from this EV market into the autonomous market? And I think there's a big question around that. But our model is really based on just their ability to sell electric vehicles at a successful rate, and we feel very good about that call at this point, and leave the autonomous piece as a free option.
Max, quickly here, in terms of competition, you have a lot of other companies, GM, Ford, coming out and trying to compete on the autonomous vehicle front. Who's their biggest competition?
On autonomous vehicles, I think, it's wide open. We really don't know what the product's going to look like. We don't know what the demand is going to look like, and that's one reason for skepticism. I think one reason you're seeing people kind of have this freak out over the last couple of weeks is there was this sudden pivot toward autonomy, which kind of makes you scratch your head a bit and ask, like, well, what's happening with the business that's generating the cash? Is that troubled? And because autonomy is still very much a question mark.
Well, Colin Rush of Oppenheimer & Company, thank you for joining us. Great conversation. And Bloomberg's Max Chafkin, you will be sticking with us. Now, employee activism has arrived at Amazon.com. An employee-backed climate change proposal is on the agenda at Wednesday's annual shareholder meeting. A proposition supported by some 7,600 employees will call for Amazon to write a public report detailing how it's preparing for climate-related disruptions and plans to reduce dependence on fossil fuels. Amazon opposes the resolution, citing ongoing efforts to reduce the amount of packaging it ships, as well as investments in alternative energy. And coming up, China pledging an unwavering resolve to fight what it calls U.S. bullying. We discuss the nation's reaction to the ban on Huawei next. And if you like Bloomberg News, check us out on radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg.
Trade is the pinnacle of something much bigger.
Far more about world power and hegemony.
Reordering of the global trading system.
Things are not moving the right way.
Things are getting more heated up.
More antagonism.
Further escalation of these trade tariffs.
It's getting more and more difficult to pull out of it.
It just adds, I guess, a bit of volatility and uncertainty to markets.
The trade war is one thing.
Huawei, to me, is a protection move.
The Cold War of tech is another.
We aren't just attacking a company. We are attacking the Chinese government, I think, to some extent.
The blacklisting away indicates that this tension will continue for the foreseeable future.
This is a 5 or 10 year story. This isn't a 5-minute story.
Now, the Trump administration held off on blacklisting Huawei out of concern the move could disrupt trade negotiations with China. The decision to curtail the Chinese tech giant's access to American suppliers unfolded quickly once trade talks broke down, setting off a scramble to implement the measures. To discuss, we're joined by Bloomberg's Nick Wadhams, and still with us, Max Chafkin of Bloomberg Business Week. Nick, let me start with you. You know, sort of the reprieve that we got for 90 days after we saw the ban on Friday. What strategy was that? Was that really just to give suppliers some time, or was there a bigger story to that?
Well, I think in part that was really aimed at Google and its relationship with Huawei. But I mean, it fits a broader pattern you've seen from this administration, where they announce a very tough line, a strategy, and a set of tactics that really boxes in U.S. companies that work with the company in the country that's been affected. And then you see a little bit of a rollback. So I believe what happened in this case was that the EO came out, the essential blacklisting of Huawei was done, and then you started to see the aftershocks of that, the disruption to the supply chain. I mean, just an enormous sort of earthquake that may have surprised the administration a little bit, not in terms of what it wanted to achieve, but what the effects would be on American companies that the government would ostensibly support. So you see a little bit of rollback, a little bit of effort to give American companies some breathing space to adjust to what was a major move, and frankly a huge surprise to the market.
Well, and part of the major move, Max, I want to bring you in here through all of your reporting within Bloomberg Business Week has been really, as you step back, a concern of, is this a 5G issue or a national security issue? What is your take?
Or just pure politics. And frankly, it could be all three. So we should say a couple of things. One is that Huawei and ZTE, which is the sort of smaller Chinese telecom company that the U.S. went after in very similar fashion to this last year, they both present kind of like a long-term economic risk to the United States, because they compete with big American tech companies that employ lots and lots of people, and there is this theoretical security risk, which is that somehow the Chinese government could like spy on communications, which we should say, number one, these companies deny. Number two, there have been similar allegations made about big American companies, if we remember the Snowden, all the Snowden revelations. So you have this kind of legitimate fear combined with like legitimate competitive issues, and on top of that you have this incredibly kind of volatile political situation, and that's kind of where we are. And the thing is, I mean, it's potentially very bad for Huawei, of course, but also just very bad for many of these big American tech companies who depend, number one, on access to Chinese markets. I mean, if this hostility situation continues, it's going to be super bad for Apple. Also, potentially, maybe not quite as bad, but still pretty bad for some of these big American chip makers who've been selling products to Huawei.
Well, and what has been their response? I mean, so far we know that some of them have revised down forward guidance, and that they have agreed to go along with the U.S. and not sell their components to Huawei. But beyond that, are we hearing any other larger calls for this isn't the right move?
I mean, I think for the chip makers, it's complicated, because Huawei is both a major buyer of chips, but it's also a long-term competitor. When you look at like who threatens a company such as Qualcomm or Intel the most, it's something like Huawei, because Huawei has these huge ambitions to make their own chips. It also has big ambitions to be totally vertically integrated. So in a way, Huawei is both a partner but also a competitor. So it's sort of a little bit of good with the bad. I think if you're sitting in the shoes of an American chip maker, it's not great, but it isn't, it's not a disaster either.
Nick, from your perspective in D.C., what is China's response? We woke up this morning and we had a very nationalistic China. That fight song went viral overnight. What does China respond? How do they respond?
Well, they, as Max was indicating, I mean, they deny vehemently that Huawei is under the thumb of the Chinese government. They say that Huawei is an established and well-respected company globally, and that countries and companies around the world should use its hardware. The U.S. administration's view, on the other hand, is, listen, Huawei may say it's independent. You can have a debate about that. But the fact that it gets heavy subsidies from the Chinese government and is also bound by Chinese law, where regardless of whether it wants to help the Chinese government, it can be compelled to turn over information, to turn over access, to basically do whatever the Chinese government wants. Well, you can say, okay, we're ostensibly independent, but you are in a system where the Chinese government and the Communist Party has almost total control. So that's the debate. On the other hand, Huawei has already made itself crucial and really integrated itself into networks around the world. Africa, for example, many countries are heavily reliant on Huawei's networking infrastructure, on its systems, on its hardware, and so pulling that out would be enormously difficult. The U.S. is now really focusing on having that debate with Europe. That's where it really sees the big battleground now. So stopping European nations from signing these contracts, European companies from signing these contracts with Huawei, and avoiding what happened in other places like Africa as 5G comes to be rolled out.
So, Max, you heard how Nick was talking about how it really is so integrated, especially when it comes to the 5G infrastructure. I read a quote earlier, and they were talking about how it's like bombing a building and then having to rebuild it from ground, that getting Huawei out of that 5G technology here in the U.S. or in Europe and coming in and having to replace that is such a difficult task. Isn't it better to do that now, if I'm playing devil's advocate, even though it will delay the 5G rollout by, let's say, a couple years, than have some of the concerns that we have when it comes to Huawei and the 5G technology?
Yeah, I mean, I think in terms of so in terms of what's been happening in the U.S., there has been we should probably say this. There's been a de facto ban on certain types of Huawei equipment in the U.S. that's been going on for years. So the major carriers do not buy Huawei routers and Huawei equipment because that has been a U.S. government concern. The buyers of that have been kind of tiny rural carriers. They're the ones who are upset about this, where things are today. But whereas, like, your AT&Ts of the world, it's not that big a deal. The bigger deal is in Europe, is in the whole rest of the world, where particularly in Europe, where 5G is important, where there are these big digital industries. Basically, countries, including England and Germany, decided years ago that it was fine to do business with Huawei over our objections, and now the U.S. government is trying to say, hey, you need to reconsider that.
Well, story that's not going away. We know that for sure. Thank you. That was Bloomberg's Nick Wadhams and Max Chafkin. Thank you for joining me. And coming up, it's all about the future of T-Mobile and Sprint. That merger hangs in the balance. Why the U.S. Department of Justice and the FCC disagree on the deal next. This is Bloomberg. T-Mobile's bid to take over Sprint hit another roadblock on Monday after both agencies reviewing the deal appeared to be split. While the U.S. Federal Communications Commission Chairman Ajit Pai announced support of the merger, Bloomberg then reported that the Department of Justice was leaning against approval. Where does this leave the merger now? Bloomberg's Vonnie Quinn sat down with MoffettNathanson senior research analyst Craig Moffett earlier to discuss.
The basis for the decision at the DOJ is somewhat different than the FCC. The FCC is taking a much more subjective public interest test. They decided yesterday that this is in the public interest, but the DOJ takes a much more structuralist view of, will this hurt or help consumers? And the usual test for that is, will it raise prices? So they tend to take a formalistic view of near-term competition and particularly price competition.
And yet it's very unusual for the FCC and the DOJ to disagree on something. So it would seem that in this horizontal merger, there's something a little strange, a little, first-timer.
Yeah, it is different than the process that we've seen in the past. In fact, historically, we've usually seen the DOJ go first, which sort of the alpha dog signaling leadership in a transaction. In this case, it's a little different. We had, they notified the FCC of some changes in the deal structure, selling off prepaid, the Boost brand, as a way to ameliorate some of the concerns over the weekend, and therefore reached a concession or reached an accord with the FCC yesterday. But the DOJ needs a little time to review that, so that'll take a few days. But remember, again, there are very different mandates at the FCC and the DOJ, and so it is conceivable that the DOJ could find that this is not good for competition, even though the FCC found it to be generally in the public interest.
I mean, is there a sort of odds that you can place on it right now? Have they moved significantly?
They probably went up a little bit yesterday, but not nearly nearly as much as I think the stock action suggests that they did. Remember, the FCC, as you said, was never the biggest hurdle. Everybody already knew that the FCC was ultimately going to bless this. The real question now is not just the DOJ, but what do the state attorneys general do? And this has become an incredibly politicized and partisan process, just like everything else in our country right now. And the fact that the FCC decision will almost certainly be when the vote is taken 3-2 along party lines, 3 Republicans against 2 Democrats, polarizes this, makes it even more partisan, and therefore makes it even more likely that the blue state attorneys general will step in and say, if the federal government, the Republicans won't protect consumers, then we will. It's a press release that almost writes itself for the blue state attorneys general.
The thing of it is, I mean, obviously the blue state attorneys general would be trying to work in the public interest and would have all of those arguments in their favor. But if we go down the road of this not happening, then Sprint becomes a very weak entity, and there's even suggestions that it might need to file for Chapter 11 bankruptcy, and then there wouldn't be a fourth anyway, so it would be a Pyrrhic victory, no, for the blue states?
Not necessarily. So I do agree with you that Sprint would need to be restructured, but remember, the failing firm provision is an actual term of art in antitrust circles, and it doesn't apply at all to companies where Chapter 11 bankruptcy is an option. It only applies to companies where Chapter 7 liquidation is the only alternative. In this case, Sprint almost certainly wouldn't be liquidated. They would simply restructure. And there are certainly those in Washington who would argue that it'd be the best thing that ever happened to consumers if Sprint would finally get on with it, restructure its balance sheet, and emerge with a cleaner balance sheet, and then be able to invest or potentially be acquired by someone else who would invest. And so the DOJ tends not to take those kinds of things into consideration. They will very clearly say, our job is not to protect bondholders. Our job is to protect consumers.
I do want to point out that in your coverage universe, the one sell rating you have is on Sprint. You also have some buys on Charter, Altice, and T-Mobile is one as well. I'd like to ask you about one of your neutrals, and that's Dish. We saw a massive drop yesterday, and it's bouncing back today. Is the idea that Dish would have no one to sell to?
It's not so much that they would sell themselves, it's that they would sell some of the spectrum that they own.
Yes.
And it's a somewhat simplistic but probably correct view that says if the Sprint T-Mobile deal is rejected, there's one more buyer, that is T-Mobile, that would need to buy mid-band spectrum. And right now, that list of mid-band spectrum buyers is mostly just Verizon, Verizon, and Verizon. And so having a second bidder would be good for the valuation of spectrum, even if Dish didn't sell it, and therefore it would probably flatter Dish's valuation. Without T-Mobile, or if the deal is approved, T-Mobile has all the mid-band spectrum it needs through the Sprint acquisition, and then Verizon has a number of potential, albeit maybe longer-term sources of mid-band, and Dish is sort of left on an island. So that's the reason that Dish has gyrated so much with this acquisition.
That was MoffettNathanson Senior Research Analyst Craig Moffett. And coming up, U.S. stocks advanced in the face of a tit-for-tat with China. Really, chip stocks rebounded as the administration granted limited relief for consumers and carriers that do business with Huawei. We discuss the broader implications for the corporate world next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in New York. Let's turn now, of course, to the ongoing trade war. Nike and Adidas were among 173 companies that signed an open letter to President Trump saying, quote, tariffs on shoes made in China would be catastrophic for consumers, companies, and the American economy as a whole. Bloomberg has been looking at who pays the cost of an escalating trade war. Meanwhile, the OECD this morning cut its global forecast as trade tensions hit crisis level. Here's what Chief Economist Lawrence Boone had to say earlier on Bloomberg.
Growth has weakened, has faded over the past years or so, and it's now quite weak, as you say. There has been trade tension, and we really think that trade has derailed the global recovery that was going on in sync in 2017.
For more, let's go to San Francisco, where Myron Brilliant, the head of international affairs at the U.S. Chamber of Commerce, is with us. Myron, great to have you. And before I sort of get into the broader story about the trade and trade fights, I want to touch on a little bit of the news, really, just in the last few days about the Huawei ban. From your side of the room over there at the Chamber of Commerce. What is your take on the Huawei ban? Is that the right approach?
Well, Taylor, it's good to be on the show. I'm out in California in part because I am talking to the technology companies out here about the China tension with the United States, and of course, Huawei factors into that. Look, a lot of U.S. companies sell into Huawei. Certainly, it's an important company. It operates in over 100 countries and has over 180,000 employees. At the same time, it raises legitimate concerns about security issues, and we need to keep issues with respect to Huawei separate from the commercial trade talks between China and the United States. So what I'm saying to you is, at the end of the day, we're very concerned about the overall environment between China and the United States. Huawei factors into that. But we shouldn't be surprised that our government is taking a close look at Huawei's operations and how it impacts our security concerns.
Well, I like that you said to separate sort of the national security concerns with Huawei relative to everything else. So let's go to everything else. At the top in the introduction, we were talking about companies like Adidas and Nike who have really started to come out and say, we're concerned about the effect that this is having on consumers. What other industries or companies are you talking to that are also highlighting these concerns?
Well, those are good members of the U.S. Chamber. But we do $2 billion of trade a day between China and the United States. We have a huge economic relationship. You're talking about the two largest economic players in the global economy. So, of course, what happens between China and the United States matters. And we are concerned about tariffs because they're a tax on consumers, they're a tax on manufacturers, and, of course, the escalation of trade tensions between China and the United States could hurt our economy. It certainly is going to hurt China's economy. But let's take a step back and recognize why we're here. We're here because China conducts unfair trade practices. It doesn't protect intellectual property rights. It forces technology transfers. It doesn't allow for a level playing field when it comes to market access. And there are a host of other legitimate issues that the administration is trying to tackle. And I think we have to remember that at the end of the day, we need a trade agreement that is a high standard, comprehensive one. We don't favor tariffs as a tactic, but we do favor trying to address these issues in the bilateral relationship. And it's something we're going to continue to push both with the United States and with the Chinese government.
So, Myron, what is the right tactic then? Because you have said that you don't necessarily support trade or tariffs, but you are aligned in some ways with the Trump administration on trying to tackle some of the issues that you highlighted, like intellectual property theft and unfair trade tactics. What is the right approach then?
Well, I think there's a multitude of things that should be done and are being done. We need to bring our allies into the picture. Of course, Europe and Japan share our concerns, and so they need to be a part of the strategy. We also need to look at ways that we can address these issues in a confrontational way, but in a way that is pragmatic. At the end of the day, we need a trade agreement with China and the United States because both countries need it. We need to put this relationship on a more stable footing. We need to put it on a more positive trajectory. We're not there. There's a huge amount of distrust in the relationship. That is not good for the United States or China or for the world economy. And at the same time, really the underlying tensions here have to do with having a competitive environment where there's a level playing field. So I think we need to think about how to do that best in the context of these talks. I'm hopeful the talks will get back on track. I don't think that's really going to happen until President Xi and President Trump meet in Osaka, Japan at the end of June during the G20 meetings. But it's very important that we bring the temperatures down and the two sides resume talks as soon as possible.
Well, you talk about bringing the temperature down, and I want to ask, how tense does it feel? What's the sweat level of the room relative to previous discussions that we've had really in the last couple months or really the last few decades?
Well, I have met with top administration officials, and I've also met with Vice Premier Liu He during these negotiations. I will tell you that we all thought a deal was likely on May 10th. They were 90% of the way there. The last 10%, of course, is the hardest part. What do you do with the tariffs that were in place? Now we've seen an escalation with that, with the tariff hikes on the existing $250 billion. But we also have to recognize that China has to come to the table in a meaningful, concrete way. Backsliding or whatever China did with respect to the issues in the text, there was a 150-page text, 7 chapters. These agreements have to be enforceable, have to be verifiable. And so I think it was right that the administration was pressing for reform under Chinese law and not just a state directive. So I hope we can get back to the table in the weeks ahead. I hope that the two presidents during the G20 meeting will set the right tone for constructive talks. But we're at an impasse right now, and both China and the United States are going to find it very difficult. They box themselves in with the escalation of tensions. But at the end of the day, this is too big a relationship to fail. There's not going to be any decoupling, and we need to see these two governments get back to the table. It's in the interest of both countries, in the economy, and of course, for the global economy.
Well, when you say that these two countries need to come back to the table, a lot of that, as you know, has to be a give and a take. From the companies that you speak to on the ground here in the U.S., what do they need to see from China in terms of concessions to make sure that there really is a level playing field?
Well, as I said at the outset, I think what you needed is in a few areas. We need to see greater intellectual property protection in the area of patents and copyrights. We need to see the end of forced technology transfer. Part of that was done through the investment law that China recently put together, but more needs to be done in there. We'd like to see, frankly, a restructuring of China's economy. We want to see the end of subsidies, and of course, we want to see tax preferences go away that favor local state-owned companies over foreign competitors. So there's a lot of areas that we need to see addressed. And of course, the administration's been clear that they want a big deal here in terms of purchasing. Those issues are still on the table, and still we're making progress. But now with the escalation, I'm afraid that both sides are sitting on the sidelines when in fact they need to find a way to get back to the table and have serious, pragmatic conversations. There's going to have to be blinking on both sides. Right now we have a very high stakes poker game going on, but that's really not in the interest of either country. I think China has more to lose here, more at stake, because the tariffs are going to hit them harder, but it's going to hit both our countries, and I'm hopeful that we'll get there eventually. It will take some time, but I'm hopeful.
Well, that's certainly something that we hear from economists as well, about both countries sort of being hit hard. Thank you. That was Myron Brilliant with the U.S. Chamber of Commerce. Meanwhile, Kyle Bass over at Heyman Capital Management, he's their CIO, caught up with Bloomberg's Vonnie Quinn earlier today and weighed in on the global impact of the trade fight. Take a listen.
I think, their mission is to promote stability and to try to maintain, this rigid financial agreement that's existed between Hong Kong, the Hong Kong dollar and the U.S. dollar for 36 years. I think I lay out the case for the fact that their economy has changed dramatically over the last decade. And in fact, what's happening now on the political front with China asserting a little bit more control over the Hong Kong judiciary, i.e. Taking away their autonomy by pushing through this fugitive extradition bill. All of those things are changing the nature of Hong Kong as a global financial center, and I think that investors need to be aware of these things because, by the way, the people that maintain the peg, the Hong Kong Monetary Authority, the peg's architects, they're never going to tell you that the peg is vulnerable, right? It's antithetical to their mission. I think it's very important as a global investor to think about where you're investing your capital. Is there a rule of law? Is there, is there fee simple property ownership? Is your money safe? And to the extent that you have a communist authoritarian government infringing on your rights and potentially extraditing people at their will in order to promote some political agenda, I think that changes the complexion of the agreements the United States and Britain have with Hong Kong.
But that's the thing, right? Because there is the Hong Kong Monetary Authority, but in this case now, there's also the PBOC. And as Mark Chandler points out, why would Beijing kill the golden goose, the goose that's been laying a golden egg for the last 36 years? Most recently, when it did come under pressure, the Hong Kong dollar peg, Beijing or somebody intervened to defend it.
I think it's really important to understand that China had built up a war chest of FX reserves that, as you know, got to about $4 trillion. That has since come down to $3 trillion, and if you look at the outflow data, even though China is not admitting to it, we think that those numbers are closer to $2 trillion. And in an economy as large as theirs, in RMB, you have to keep growing your reserve balance to interact with the rest of the world, right? China is desperately short energy, food, basic materials. They have to pay dollars for those things. So we all talk about China as being the world's great economic power and the engine of economic power. However, they're 15% of global GDP if you convert their current RMB-based GDP to dollars. But if you look at the SWIFT system, less than 1% of cross-border currency transactions actually settle in the Chinese currency. So there's this huge anomaly that exists where China actually is desperately short dollars, and then that moves into Hong Kong, and so China's house is on fire, and you're telling me that they're going to lend a few fire trucks to Hong Kong. The problem is the construct of the system and the cross-border currency flows in Asia.
That was Kyle Bass, Heyman Capital Management CIO. And coming up, the massive tax bill facing the family of Samsung's ailing chairman and who may end up in charge of the tech giant. This is Bloomberg. The U.S. Postal Service is experimenting with self-driving trucks starting Tuesday. Trucks run by autonomous startup Too Simple will begin hauling mail between Phoenix and Dallas in a 2-week pilot program. The trucks will complete 5 round trips between the postal centers with a safety engineer and a driver on board. After 2 weeks, the Postal Service will assess whether to continue working with Too Simple. The startup has raised $178 million in funding since 2015 and has been carrying cargo in Arizona since last year. Now, Bloomberg Businessweek's upcoming money issue turns its attention on Samsung's 77-year-old chairman, who has been incapacitated since a 2014 heart attack. And the heirs are worried they could get hit with a $7 billion estate tax bill at his death and lose control of the tech giant. Bloomberg Businessweek editor Pat Regnier joins me now. This was a fascinating story. So talk to me about the chairman, who we think, would pass in a few years or so, and then sort of what happens with this family and all that tax bill money.
Mm-hmm. Well, he's incapacitated. The company says that he's in stable condition, but people in Korea are watching because the Lee family that controls the Samsung conglomerate is one of the most important families in Korea. It's both politically powerful and powerful economically. He has a wealth of about $15 billion, according to Bloomberg. Mm-hmm. So there's a lot of money there, but the interesting thing about South Korea is South Korea has one of the biggest estate taxes in the Western world. So they take a pretty big chunk, and that's where the $7 billion tax bill comes from.
Okay, yeah, so I wanted to just talk about that a little bit because $7 billion seems like a ton of money. And like you said, it could be about half. But then you look at a company like Samsung, they're churning out $30 billion in profit annually. How big of a deal is that $7 billion tax bill?
I think it's not really about the money as it is about what do you have to do to come up with that $7 billion, right? It's not $7 billion in the bank, it's $7 billion in different kinds of financial assets. The Samsung conglomerate is like a web of a lot of different companies. And for example, Lee Kun-hee owns about less than 5% of Samsung Electronics, which he's the chairman of. The way that he has control is through this kind of web of different companies and also by having a lot of influence throughout Korea. When you have to upset the balance by potentially, liquidating assets, selling things in order to pay a tax bill, that can throw the family's control of this business empire into doubt.
Any idea what would be sold?
I don't think we know that. It's a very kind of foggy situation, or even whether it would happen. This is always, a complex political situation, and we'll have to see, what happens when it happens. All eyes are on his son, J.Y. Lee, who's had a difficult few years.
So talk to me about that, because he's really the key player, that once the chairman passes away, his son, J.Y. Lee, sort of emerges as a prominent figure here. He might, though, not have the political influence that his father had.
Right. So we've talked about sort of the soft power that you have to use when you own a little bit of this company and a little bit of that company, and you're sort of connecting, all of these different strands of a company. J.Y. Lee has run into some trouble. He spent some time in jail recently and was released early. That was a case having to do with bribery and corruption that had to do with an attempt to merge 2 Samsung affiliates and to try to get government approval for that. So he's appealing those charges, but at the same time, the family is just very divisive in in Korea, and it's becoming a sort of a hot political issue about, like, will they be allowed to, continue to control this large business empire?
So fascinating. Thank you. That was wonderful. That was Bloomberg Business Week Money Issue Editor Pat Regnier. And hear more of the magazine's editors and reporters every Saturday and Sunday mornings on Business Week on Bloomberg Television. And still ahead, tech startup People AI is transforming how many companies gain sales and market their products. But can it compete as a tech giant like Microsoft and Adobe? This is Bloomberg. Closing a deal can be a make or break moment for sales teams, but one startup may be able to help. People AI has created a platform that captures customer data and provides guidance to help sales teams save time on manual work and close more deals. The predictive playbook company has already attracted top tech clients like Lyft and Zoom, and today it's announcing $60 million in new funding. Joining us from San Francisco to discuss is People AI CEO and founder Oleg Roginski. Oleg, thank you for joining us and congratulations on the new funding round. What are you going to use the new money for?
Hi, Taylor. So the new funding that we're going to use is to build more of the AI technologies that we've been using to date. Just to go back into what People AI does, companies use our artificial intelligence to supercharge their sales teams. And so we've been growing really fast. We grew about 500% last year, and we're seeing a lot of global demand. So the new funding is to address the demand from enterprise companies all over the world to use our technology, build new features, hire more engineers, as well as build out a partnership platform for global systems integrators to deploy our software at customers.
Talk to me about some of the customers that you target. You're working with companies like Zoom and Lyft. How do you differentiate yourself from some of the competitors out there to remain cutting edge and really attract all of those top customers?
Yeah, absolutely. So the biggest draw for companies like Zoom and Lyft and Splunk and New Relic to what People AI does is two parts. Our product delivers both, we call it autopilot, productivity of how salespeople operate. We literally free up about 1 to 2 days per week for every salesperson back on their calendar. And the new product we announced today, the Wire, which we internally call the Copilot, which whispers into salespeople's ears basically what to do next, the best next action they could be taking. And so Lyft used to be one of the first customers of ours, and Zoom joined soon after. Zoom actually reported that our software has increased the productive sales activity, the sales team outputs, by about 44% just a few months after we deployed the software there.
Well, and being productive obviously is a good thing. I want to play devil's advocate a little bit because you talk about how using this AI technology can save a salesperson, let's say 30 to 40% of their time so they can focus on other things. There's been a lot of conversations about tech and robots and AI taking people's jobs. Make the case for why you're not taking their jobs but freeing them up to do bigger and better things.
Absolutely. We believe that salespeople will still be needed to do sales. In fact, true sales is about building a face-to-face relationship with your clients. And robots are far away from being able to build that relationship with you and me. And so the way we look at artificial intelligence, it's about augmenting people. It's about giving them superpowers. And so People AI is looking to provide salespeople with an ability to focus on what moves the needle, what drives results, instead of having to deal with all the admin work or deciding who to call on next or what kind of lead to process next.
It's a very competitive space. We know companies like Microsoft and Oracle and Salesforce are also coming out with some of their own AI products. How are you going up against bigger competition?
We are following the playbook of DocuSign. They play well with everyone. And so if you look at People AI and how we work with other companies, we actually make them better. For example, Adobe customers of Barkero, their recent acquisition, really benefit from all of the context we automatically create from sales communications. And Salesforce, we make them better as well by delivering all this really valuable, comprehensive, real-time sales activity and contact data into the CRM that Salesforce provides to their customers as well. So it's a very mutually beneficial relationship with pretty much all large players in customer relationship space.
Well, we've talked about some of the customers. I also want to talk about some of the investors. You have some pretty well-known investors of putting money into your company. I imagine they're happy with the top-line revenue growth. Any path to profitability for you? Any pressure to go public? We hear a lot about these tech IPOs that we're getting so far this year.
We are focused on growing a healthy, independent, long-lasting company. And so right now we are focused on executing on the demand we are getting from large enterprises across the globe. And so that's what the funding is for. Wherever it takes us, we don't know yet. But right now it's all about growth and execution.
Well, thank you. Growth and execution. That was People AI CEO and founder Oleg Rokinsky. Thank you for joining us. And finally, Apple has launched the fastest MacBook ever. The tech giant introduced an updated MacBook Pro Tuesday with 8th and 9th generation Intel Core processors, bringing 8 core processors to the laptop for the first time. Apple says the new model will deliver 40% faster performance than the previous version. The company separately announced it has changed the material used in its keyboards and is extending its repair program after users complained about sticky keys. And that does it for this edition of Bloomberg Technology. Remember, we're live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. Thanks for joining. This is Bloomberg.